Is it too different from a lending perspective, going for a first home versus a investor type loan, right? Now, how do you see that? What's the main difference when people are approaching for for their first investment property?
Um, let's talk about the value of the property and the value of the loan that one can afford. So let's say I'm earning about 120,000. If I was to buy a owner occupied home, I would potentially get say 480 as a loan, right? Because now I'm directly going from the rent changing into a mortgage.
Yeah.
Financing for investors is different because from first time buyers, because investors are assessed slightly differently because of the rental income being included. So it's almost that another income gets added for an investor. And also, you think that you're getting 100% of the rent as income, but that is not the case because lenders usually use something called rent shading because they say that you may have some vacancy, you may have to do some repairs, all that is included in the total income of the rent. So rent shading is where the bank is only using 70 to 80% of the rental income to calculate borrowing capacity. So like I said, it's to account for vacancy periods and property expenses. So for a $500 rent coming in, bank will say 350 or 400 in servicing calculations. But to answer your question, if you can't find a house in that 480 plus your savings, you will then be better off doing something rather than nothing, is to do investing. That you go and stay in the rented accommodation or at home, whatever the situation is, but you buy something for 500, 550 with your same budget in an investment situation, and then you also get something which is a double benefit if you do that. Also get something the government has still kept, which is negative gearing, which also increases the borrowing capacity. The tax depreciation or benefit is there, and the negative gearing helps your tax position.
Mm-hmm.
They don't increase the borrowing capacity.
Oh, okay.
It increases your actual cash flow and income stability.
Okay. That's actually very interesting. Probably a myth people have. When they are getting properties which give them higher depreciation benefits, the cash flow is good. I think invariably they start assuming that their borrowing power also goes up. So it looks like when borrowing power is calculated from an investment property, it's purely the rent that is factored in, not really the depreciation benefits or the negative gearing or anything of that sort. Yeah.
No, it is income plus rent, which is
Yeah.
used for our lending purposes.
Okay. Okay. That makes sense. That makes sense. How like there's always this question of like people hitting their borrowing limit, right? And for example, a couple making about like 150 each, like 300,000 per year, like whatever it is, they are going to have like 1.5 mil, 2 mil, whatever it is, it's going to be a higher limit. To get past that, people start thinking, can we buy in terms of trust and companies and everything? How do you see that? Like, do you see the lending from a trust and a company very, very different to, let's say, buying on a personal name, investment property, especially somebody with an ambition of building a good sized property portfolio? How do you see that?
I'll share another story. This is about one of my clients. It's really seeing where is your trajectory of income coming from. What does it look like before we start talking about the different structures? But understanding the structure is very very important. So I'll give you an example,
Mm,
and it's very memorable for me. Very early on, he's still my client for the last 15 years. His name is Ali. He was a migrant from Iran,
mm,
and he started an air conditioning company with a business partner.
mm,
And I was called in to say, okay, we're doing very well. We want to buy a home.
mhm,
But in that period where we were waiting for their tax returns to be done, I got to know, that the business was structured as a company
Mm-hmm.
and they were not taking any PAYG wages. They were taking income at the end of the year as directors' wages, right? And I started to also detect that there was some dissent happening between the two partners.
Mm-hmm.
So the person who started the conversation to buy his home, even though he was a first home buyer, I actually suggested setting up a trust structure.
Mm-hmm.
This is even when he was a first home buyer. Time it seemed like a small structural decision, but a few years later, the partnership dissolved.
Mm-hmm.
But because the assets and income are structured correctly, Ali was able to retain the wealth created during that partnership and protect his position. And he has a substantial, portfolio which has grown, and he lives in we- with in the same house, and
Mm-hmm.
there are a lot of land tax and structuring and all that with every non-individual entity. So understanding what is a right structure and why you want that structure is very, very important. And it was something that the structure essentially saved years of work and income. Otherwise, if it was named in the same company and he was getting wages from that company and he had the property say in his own name, when the partnership dissolved and there was legal problems, it would have been pulled into the pool of assets for the division.
Mm-hmm.
So financial structure matters as much as the loan itself. Sorry to go in such a roundabout
No,
way,
no.